Well, good morning, everyone, and thank you for joining us on our latest Actionable Ideas webinar. With us today, we have our Chief Investment Officer, Sandip Bhagat. Before we get started in earnest, two housekeeping items to remind everybody of. First, we will have three poll questions for you to answer during the presentation. When it's time, the questions will pop up, and you can participate by clicking your answer directly on your screen. Second, we will reserve time at the end of the presentation for your questions. You may enter your questions at any time by clicking the Q&A icon located in the top right corner of your screen. So, Sandeep, let's jump right into it. We've seen headlines coming across about inflation and how it's being impacted by the labor market and job growth. We've also heard a lot about economic growth, and the pendulum seems to swing back and forth between a recession and a soft landing. So, can you help us decipher all these mixed economic signals?
Thanks, Teague. And it is great to reconnect with many of you again. And you're right, it is quite amazing how investor sentiment has changed so much in the last several months. So, at this time last year, a US recession in 2023 was all but a foregone conclusion. And those unanimous calls back then seemed justified, right? After all, growth was clearly slowing, the Fed was tightening aggressively, the housing market was falling, the yield curve was inverted, and the global economy was in even more dire straits. And if all this wasn't bad enough, T, it got worse at the beginning of 2023. We know rapid monetary tightening inevitably leads to a financial accident, and this time it led to the collapse of a handful of US regional banks in March. And yet, somehow, through all this turmoil, the US economy has remained remarkably resilient. So the debate right now is not so much between a hard landing or a soft landing in the US economy. We've actually added a third option to this lexicon of economic outcomes. We now have the possibility of a no landing. We'll assess which of these three outcomes we might see in 2024. But let me quickly define first a hard landing, just so we can frame the issues, is a conventional recession with growth below -2% for several quarters. A soft landing is almost zero growth, maybe even slightly negative, and this would be along the lines of a short and a shallow recession. And finally, this new no landing would see growth above zero. It would be close to normal trendline levels, which for the US is probably around 1.5% to 2%. So, our pursuit of this answer takes us to three related topics. These are our main discussion points. So, first, inflation. Is it too high or is it low enough? We've made significant progress with disinflation in recent months, probably more than many had expected. So, what's next? I just wonder, what should we do here? Should we celebrate this outcome? It is a successful milestone on the journey to a soft landing. Or should we, as some are doing, fret instead that, well, inflation is still way above 2%, and any unusual economic strength from here on will simply reignite this inflation. It will send rates higher and then trigger an even deeper recession down the line. Second, we focus on the economy. Is it too hot or will it become too cold at some point, maybe soon enough? Probably not. There are some estimates that put third quarter GDP growth at more than 5%. I mean, is this even plausible? How sustainable can it possibly be? Finally, we'll talk about earnings and corporate profits. Are they high enough to support stock valuations, or will they sink lower under the weight of higher interest rates? Well, I thought I would throw in one extra topic. We just finished the G20 summit 3 days ago. I'll briefly touch on geopolitical risks. They are so much in the news, and we'll look at the impact on the US dollar. So let's begin with inflation, but let's start by understanding how you feel about inflation. Teague mentioned we have a few poll questions embedded inside our presentation. So here is the first one of them, and we're going to push this out to you while you scan these and think of your response. I'll just read them out. Do you think inflation is too high? Is it likely to go back up? That's choice one. Is it high, but will it subside in a couple of years? Or is it already low enough and on its way to reaching target next year? So I'm just going to guesstimate that enough time has elapsed for you to respond. And so perhaps we can take a look at your answers. So I don't know how many participants we have, but every single one of you is saying that inflation is high, but it's going to take 2 years or longer. So we'll come back and share an answer and a perspective with you, but this was super helpful. So let's begin with inflation, right? So we're going to focus on consumer price index uh, inflation. And we did get up early this morning to update the latest data from 5:30 in the morning. So what are we looking at here? The blue line shows headline CPI inflation. It peaked back in June at 9.1%. It has since then declined to 3.7% as of August. Clearly, it looks like we are way past the peak in inflation. But you notice that there are some small upticks at the far right, right? July and August see a bump in headline inflation. Is this cause for concern? Uh, the small spike in headline inflation in the last 2 months is attributable to the recent rise in oil prices. We think at this point, most of the gains in oil are behind it. There is limited upside to oil prices. So this is not alarming to us. The other line, the green line, shows core CPI inflation. This excludes the volatile food and energy components. Core CPI inflation is 4.3% as of August. Now, core inflation is notoriously sticky. But on a positive note, you can see that even the green line is declining steadily, right? And in fact, today's data showed a further decline in core inflation. And there is optimism if you look ahead that this trend will continue. Here's why. Core inflation is made up of entirely two components, right? You have rents and you have wages. We look at each one of them separately. So let's take a look at rent inflation first. And the blank screen is by design. Before we even look at any data, I just wanted to describe ever so quickly why rent inflation in particular tends to be so, I don't know, annoyingly sticky, right? So here's how rents work. We know they get negotiated. A lease is a 12-month lease when you sign up for a new rental. It takes exactly 12 months for the entire stock of leases to get repriced. So in the meantime, even as rents on new leases begins to come down, you have older leases that were at previously higher rents, and this artificially slows down the measured decline in rents. So you will always see a lagged, drawn out, and sluggish trend in shelter costs. And what does the actual picture look like? Well, here it is, right? So you're at this long, slow, steady increase higher. But the good news is shelter costs finally seem to have turned the corner in the second quarter. And the projections here, looking further out, are from the Dallas Fed, and they suggest that this will remain in a steady decline for the next several months. The second equally stubborn component of core inflation is wage inflation. Let's take a look at that. So, how are we going to think of wage inflation? Let's settle on something called average hourly earnings. So, the year over year change in average hourly earnings right now stands at 4.3%. This measure of wage inflation peaked, I don't know, almost a year and a half ago at around 6%. It has since fallen steadily by almost 2 percentage points. And on an even more positive note, if you look at just recent months, the annualized pace of wage gains in the last few months is actually below 4%. This is remarkably rapid progress on wage inflation. And even more remarkably, we have achieved this disinflation without any disruption or major disruption in the labor market. So let's take a look at what exactly I mean by that. So, look, the US economy is very simple to understand. As goes the consumer, so goes the US economy. And as goes the US labor market, so goes the US consumer. And the US job market has been unusually strong and resilient. We show the unemployment rate here on this chart. And you can see that in the last 18 months, where on the previous slide, wage growth had fallen from 6% to 4%, the unemployment rate here has been remarkably steady, horizontal between 3.4 and 3.8%. Now, clearly, you don't see this type of strength in the job market if you have a sharp and imminent recession right ahead of you. And we have seen this a little bit of a disconnect, right? There is a contradiction between a strong labor market and falling wage growth. And I think it just raises a question about what is driving this inflation. So let me kind of formally make this a question to address, and we need help from the Fed to figure this out. So we know the Fed has tightened aggressively. In fact, this tightening cycle, shown in the blue line here at the top, has been the most rapid one in recent history. We've seen a lot of disinflation in 2023. We saw a lot of inflation in 2022. And how did all this come about? Did we see that original spike in inflation because of massive stimulus and the excess demand that it created? Is this subsequent disinflation being triggered by demand destruction from Fed tightening? Are we already seeing the lagged effects of this tighter monetary policy? Or is there something else at play? Something like, did the pandemic create supply side shocks? They have since abated, and that is providing some meaningful disinflationary relief. So let's go back to the labor market to get an answer to this question. And I'm already here. Before I advance my slide with trepidation, I'm going to ask for your indulgence for moving to one of my more complicated slides, so which looks something like this. Okay, so I'll just walk through this carefully and slowly. We're showing the inverse relationship between wages and the unemployment rate. Wages are on the y-axis and the unemployment rate is on the x-axis. The most common shape of this relationship is represented by the light green dots in the middle. Quite simply, it says when wages go down, the unemployment rate rises sharply on the x-axis. So you see a cluster of red dots at the top. This is the post-COVID recovery. Let your eyes go to the top left corner of this chart. You should see two dotted lines on either side of a red fulcrum. Now, the market has been worried for a long time now that any future wage employment relationship is going to trace that diagonal red dotted line, which is at the right end of the fulcrum. In other words, if you went down this line, for wages to decline from 5% to 4%, the unemployment rate would have to go up sharply to 6%. However, we just shared some data with you that showed that the actual wage employment data has been a lot closer instead to the vertical line, which is at the left edge of the red fulcrum. So there's a red oval that I drew out. There are some dots inside that red oval, top left again. And this is what we have seen recently. Wages have declined from 6% to 4% without creating a rise in the unemployment rate. And this, to me, suggests that there was indeed a transitory supply side component built into this inflation cycle. So, in other words, the pandemic created supply chain bottlenecks. They have since resolved themselves all on their own as the virus has now become endemic. So the good news is wage inflation is coming down without major damage to the job market. But how far can wage inflation decline? More importantly, can it go back to pre-pandemic level? So here, I don't have such encouraging news. The answer, in my opinion, to that question is no, not quite. Why do we say that? There are a few reasons that may leave us with secularly high wage inflation. And really, the big driver of this is quite simply an aging population in the US, and that's driving labor shortages. And we have seen a tight labor market in recent years. So I said all this in a vacuum. Let's start looking at some data and evidence, right? So we see this demographic trend that I just mentioned in this chart. And we are looking at the labor force participation rate. What is it exactly? It's the proportion of the working age population that is either working right now or actively looking for work. And this participation rate, the actual participation rate is shown in the dark green line, and the trend line, a smooth average, is in light green. As the baby boomers age, the labor force participation rate has been declining steadily for the last 20 years. So, not good news for the availability of labor. Let me show you a couple of other slides to illustrate our aging population as well. So, the Congressional Budget Office estimates in this chart that the US population, it will continue to grow, but it's going to grow in the next 30 years at a much slower rate of only 0.3%. This 0.3% for a growth rate is only one third the growth rate that we have seen in the last 40 years. That has been 0.8%. In fact, turns out most of this even slower growth will come from net immigration. That red oval is a bit of a sad milestone. It actually shows that with the aging of our population, deaths will exceed births in the US by year 2042. One final slide on our shrinking labor force, and that's shown here. Well, what do we have here? This is simply, it's a long way to describe it, but I'll give it my best shot. Think of the percentage of people age 65 and older. Compare those people to the number of people that are between ages 25 and 64. So it's a proportion. This percentage of people 65 and above compared to people 25 to 64 is projected to rise from 34% today to 46% in 2053. So, look, this declining labor force will continue to constrain labor resources. So I leave you with a takeaway. Even as wage inflation comes down, it is unlikely it will not subside to pre-pandemic levels. And therefore, we're looking at a higher terminal rate of inflation. There is one additional factor at play related to the pandemic. I'm going to really zip through this. This shows how many fewer workers we have now in the labor force compared to the beginning of 2020, and this is sorted out by different age groups. The largest cohort of these missing workers is shown at the far right. It's enclosed by the red oval. It's in the age group of 65 and above. These folks probably went into full retirement. They're unlikely to re-enter the labor force. So you have this tiny COVID-related effect, a longer demographic trend. I think that leaves us with both wage and overall inflation that will be higher than what we saw in the last cycle. We ain't seeing 2%, much as the Fed would like to. We probably get to 2.5 or 2.6 or 2.7%. So that's our full treatment on inflation. It's time to come up with some takeaways. So may I leave you with these forecasts? I'm going to use the Fed's preferred inflation gauge. It's called the core PCE, Personal Consumption Expenditure Index levels. It stands right now at 4.2%. We had predicted at the beginning of the year that it would decline all the way to 3.8. I still stand by that forecast. By June of next year, core PCE will be at 3.2%. At the end of next year, as low as 2.6%. Remember, we don't expect it to go much lower, so I've circled that to be our terminal rate. We just made the argument that a chunk of inflation was transitory, which is why we are seeing disinflation without any connection to demand destruction, at least as seen in the job market. And with these trends in place, if core inflation goes below 3% and the Fed is sitting at close to 5.5%, they, I dare say, will become quite restrictive. So the market expectations is for 4 rate cuts. I fully expect them to do 5 or even more. So let's turn our attention to the economy. This is your classic, what would I call it? It's a Goldilocks question, right? Is it too hot, too cold? In fact, I think the poll question pretty much says that. And so, again, if we can push this poll question out to you, all of you, I'm interested for sure, would like to know whether you think that the economy is too hot, too cold, or just right, neither too hot nor too cold. And I can't quite play the Jeopardy tune, so I'll wave my hands. Oh, here we have some answers. So half of you feel that the economy is too hot, and that's really going to hinder progress. On inflation, it ties back to your earlier suspicion that inflation is going to take too long to actually come down to target levels. So 50% say too hot, the other 50 are divided between. We have divergence, right? Many of you feel it could be too cold. We'll have the recession too hot. 1 out of 4 things is just right. I will give you the big takeaway. That's the whole gist of the presentation. Let me just share some data about the economy with you. And what I'm going to do in the next few minutes is that I'll rapidly plow through slides, and I'll be a classic politician. I'll make some observations which will be made on one hand. And if that alarms you about the economy being too hot or too cold, I'll immediately diffuse it with some comments on the other hand, right? To balance it out. So we talked about the unemployment rate remaining abnormally low. That would suggest that the US job market is actually too strong, and that could make the economy run too hot. So I reproduce the unemployment chart on the left. That's your too hot metric, to which I will immediately counter that if you look at job growth on a monthly basis, clearly on the right side, it is coming down. It is absolutely coming down. We averaged 400,000 new jobs per month last year. We are running at a level half of that, maybe even slightly below. So if you're worried, left side says too hot, the right side says, well, no, it's cooling down. But then look where job growth has descended. It is actually at the pre-COVID levels, no lower. So it's cooled off just sufficiently. We're not in too cold territory. What else can we look at? Still on the job market, these are continuing claims. When they go down, when unemployment claims go down, that's a strong economy. When they go up, it's a weak economy. So they were trending higher. So we were moving in the direction of too cold. But if this alarms you that we are too cold, let me quickly point out that they have reached a level no worse or no different than what you would see in a normal economy. So it's cooling, but actually favorably so. So we take the too hot concerns off the table, and it's not become too cold quite yet. And it goes on and on and on. I'm showing Purchasing Managers Index. It's a gauge of economic activity. Manufacturing, you would say, oh, by the way, a number below 50 shows contraction. We're clearly in a manufacturing recession. If you're alarmed or spooked by that, in the direction of too cold, I offer you services PMI or economic activity, which is nicely above 50. And so that kind of balances out. For those of you who are monetarists and look at money supply has seen a big precipitous decline. In fact, that shape of the decline in the growth of money supply was last seen in the 1930s when we had something, I think I vaguely remember reading about the Great Depression. Now, if that doesn't spook you, if we have a data point resembling the Great Depression, man, you better pay some serious attention to that. If that seems too cold, then the positive on the other side is while the growth of money supply is shrinking, it was already at such high levels that even with the decline, we still have levels of money supply well above trend. Just means there is a lot of liquidity sloshing around in the economy, and that bodes well in terms of being stimulative. And finally, consumer spending. The US economy is 70% domestic consumption and the US consumer at the far right. In 2023, after a full year of taking blows from unusually high inflation, both 22 and 23 real consumer spending growth is in that 2.7, 2.9 range, which, if you look back towards your left, is the average experience of the US economy. So nothing alarming there, not too high, not too hot, not too cold. And so let's preliminary begin to summarize that the economy is right where it should be. It's in a good spot. The future direction is for more weakness, and then I'll give you a final view on just how bad that impending weakness might be. So let's switch our attention to earnings here, right? And the question is, are they high enough or are they heading lower? And before I share some information to answer that question, curious how you think, that brings us to our third poll question or response from you. And this is just two choices. Uh, I guess we could push them out right now. The question is, are company earnings forecasts looking ahead, are they high enough to support valuations in a bull market? Or are they going to start heading lower and then trigger another bear market? So tick tock, tick tock, tick tock, tick tock. They're high enough. And I think that's a solid answer because I'll show you exactly what is going on with earnings. Where earnings were last year, where are they right now for 23? Where will they be in 2024? And therefore, what is that trend here, right? So here is the picture, three lines. Think of the line at the very bottom at the far right. This is your earnings forecast for 2023. The one at the top is the same number for 2024. And not surprisingly and curiously, the line in the middle is a blend of the two, right? So on any given day, if you were to look 12 months ahead, which means you would take some of 23, some of 24, glom them together proportionately, what does the next 12 months earning look like? And if you really stare and squint, looking for that optimism at the far right, you will see a tiny wiggle up for the top and the bottom lines. Those earnings estimates are actually inching up. And as time goes by, as more of the next 12 months actually represents 2024, that is having an effect on the next 12-month earnings. And so the line in the middle actually bottomed out back in April. So very simply, for those who are puzzling about why is the stock market going up and things don't feel great, well, future earnings have been going up steadily from April, and the market may have figured that out even a few months before that. So all of this looks good on the earnings front. So where should we take this from here? Um, Look, we have studied. So the question is, rates are high. They could go higher, cause more damage to this aforementioned consumer spending, to corporate expenses. And we have a couple of things to fret about there. Our fiscal outlook is not that attractive. So let me dive into this. I'm going to talk about debt, deficits, inflation, and interest rates. We all know what has happened in the last 10 years. So here is an attempt to look at even more data going several decades beyond the last 10 years. And the question is, how much higher can rates go? And with that uh, headwind, what happens to earnings, both from the impact from the consumer and from corporations? So what am I showing here? These are deficit levels in two countries. On the left, we show the US, the connection between US deficits and US inflation. On the right, it's the same relationship, but for Japan. I know it's a little counterintuitive to go from right to left, but the chart on the right is just so striking. Let's start there with Japan. Really, it hasn't mattered what the level of deficit has been through policy decisions. We just have seen no inflation in Japan. So here's one, I know, cherry picked, perhaps narrow data point that says the connection between deficits and inflation may not be that strong. How does it look in the US? And again, it's not compelling or obvious. It doesn't jump off the screen that, by golly, if your deficits exceed a certain threshold, you are in deep trouble by unleashing inflation. In fact, the last time inflation spiked up a lot, deficits were a lot lower than what they have been in the last couple of years. So I'm going to leave this observation as being mixed. I don't see anything compelling connecting the two. But what about debt levels? What happens to debt and bond yields, right? Because our fiscal concerns have everything to do with a high debt to GDP ratio. And again, when inflation kind of went off the rails in the 70s, we didn't have it. This is the middle of the chart on the left. We didn't have a particularly high debt to GDP ratio, right? So again, this is a loose connection. And I know we have the most unusual bond market that lasted more than 3 decades, which allowed us to support higher debt levels, and rates are beginning to rise. But longer term data doesn't immediately make this a screaming or blindingly obvious conclusion. So I'm going to switch gears and look at something else about interest rates, and something s- critical and germane to the bond market, right? So there is the notion of a term premium when you think of long-term interest rates. When you think of bond yields, there is an embedded premium. So let's simplify this, right? What the hell is a term premium? That's too jargony. If you're an investor and you're willing to tie up your capital for a much longer period of time, the compensation that such investors would demand to bear the interim interest rate risk is called the term premium. Okay, so something interesting has been happening with term premia, and I want to share that with you. So we'll kind of zip through this. Can come back to it in questions. Here is a chart that shows the 10-year Treasury term premium. The computational details are complex. The source is reputable and reliable. This is from the Federal Reserve Bank of New York. And you can see the term premium has been in a secular decline. In fact, this shows it from 1985 through recently. The average term premium over the entire time period was 150 basis points. But if you isolate the last 10 years, the term premium has been close to zero. So there are a number of reasons why the US term premium has declined over time. They're listed out here. I'll let you browse through them. I'll quickly give you some context. So we know the Fed has embarked on quantitative tightening. Uh, so they're trying to reduce their balance sheet, but it is still very large. The Fed is still a big buyer of long term bonds. That should put downward pressure on yields. US treasuries are also extremely desirable for a number of constituents. You have a glut of global savings, you have foreign investors and institutions. What's a good institution to think about? Think of a pension plan, right? They have very long duration liabilities that they need to hedge with long duration assets. They love US treasuries, right? And then, excuse me, you have for a very long period of time, right? Especially prior to COVID, you had a long trend of disinflation that came from technological innovation. The Fed has been very transparent through its signaling and forward guidance. This has reduced interest rate volatility, and therefore the compensation for bearing risk has gone down. Long story short, I believe these and maybe a couple of other reasons leave very limited upside for interest rates from current levels. Okay. So I don't expect runaway interest rates. And finally, point out that even for the fact that rates have already gone up, whether they go up any further or not, has a lot of damage been done. It turns out that the consumer and corporations have immunized themselves to this recent rise in rates. And how did they do that? So let's talk about the consumer first. What they did was they locked in low interest rates on debt, on big ticket items, on mortgages, on auto loans. They moved into low fixed rates between 2008 and 2020. We'll give you a quick example of that, right? So here is the first of two slides that shows today only 11% of outstanding household debt carries interest rates that fluctuate with some benchmark. By contrast, this proportion was almost 40% in the late 1980s. So yes, you have floating rates on things like credit card loans, right? And they have been rising with the Fed's tightening, but a big proportion of consumer debt is fixed at low rates from a few years ago. This allows consumers to continue spending despite the recent rise in interest rates. Another metric to show this effect, households today, look at the far right, they pay less than 10% of their disposable income to stay current on their debts. Those are the payments that they need to make. 10% of disposable income. This is despite the rise in interest rates. Again, why is that? It's way below the level seen in 2008. And it really, quite simply, the consumer balance sheet has a lot of fixed rate debt. And that, I think, is making the US economy less rate sensitive. And we see the same thing. What we said about the consumer is true of corporate balance sheet and corporate income statements. So, one quick data point here, corporations also refinanced a lot of their debt to longer maturities and at lower fixed rates in the last 5 and 10 years. So at the far right here, despite the massive increase in Fed funds rate, would you believe it that the net interest payment that companies are making today after the significant rise in rates is lower by almost $100 billion? Okay, so could earnings growth rates slow down? Yeah, there is a lagged effect of the higher rates. There might be a potential credit crunch. So the growth rate may slow down. We just don't see a big significant decline in earnings from higher interest rates or wider credit spreads. So let me summarize the bond and the stock markets and then begin to wind down so that I can take some of your questions. So here are some takeaways. I suggested that the upside to interest rates may be limited from here A lot of people are spooked about the 10 and the 30-year bond rates being above 5%, maybe 5.5 for a long time. I say for most of the next decade, they'll be below 5%, probably handily so. There's a lot of noise right now. It'll take a few months for the dust to settle. When that happens, the 10-year will be right around 4%, maybe a touch lower, less than where it is today. And the 30-year won't be a whole lot higher. So I don't see long rates above 4.5%. And on the stock market side, um, what do we have? I have fairly high conviction that we actually made the stock market low back in October of 2022. That marked the beginning of a new cycle. I think it's an equity bull market that will persist. Looking, what would it be, 15, 16 months out? If I go to the end of next year, I see the S&P 500 higher than from here. And if all of this seems just kind of hopelessly romantic or bullish or idealistic, I'll just politely point out that some of our forecasts from the end of last year have, at least so far, panned out. Against all odds, I had suggested that the S&P 500 would remain above 3,800 this year. That was a minority view back then. That has come to pass. We had set minimum levels for what the PE would drop down to, what earnings would be, and those have played out as well. So let me quickly wrap up uh, about geopolitics. And the reason, the impetus for this is people believe that the Fed is at the end of the tightening cycle. So the prospects of lower policy rates in the US has put downward pressure on the dollar. And so that just put the dollar on the radar. And then it's just become a topic of intense debate because of a number of different threats. And I just thought, I read a lot about the G20 over the weekend. It was in the country where I grew up. So I said, let me throw in some really quick views on the dollar. So the catalysts for de-dollarization, what are they? Are there any alternatives to the dollar? And why are we so enamored by the fundamental strength of the dollar? So let me tackle those questions. And the recent impetus for de-dollarization, I think, stems from a rise in geopolitical tensions. You can trace it back to the war in Ukraine. A lot of bad stuff happened or started from there. On one hand, the US and Western allies imposed several sanctions on Russia. And conspicuously, on the other hand, Russia's traditional allies in the East have not condemned its actions in Ukraine. So you have this misalignment on the geopolitical front, and that's leading to this decoupling, right? And a talk about desperately trying to de-dollarize. So we, what should we do here? I'm just mindful of time. So let me make some really quick comments. So what are some viable currencies here? This might help set the stage. This is what has happened to central bank foreign exchange reserves in the last 25 years. Yes, the share of the US has gone down from 70 to about 60%, but even at that, it's three times as dominant as the second competitor, which is the euro. We rule out the yen and the pound as viable alternatives. We think of three ever so quickly. Let's land on the euro, the yuan, and potentially, a basket of currencies. So let me tackle this one at a time. The eurozone suffers from two potential problems. First, it exhibits fragmentation risk. The Eurozone has a common currency. It does not have a common sovereign bond market, and it does not have fiscal integration across its member countries. Just makes it harder for, for everything to be properly coordinated. Remember, they're always aligned with the US. So if the idea is to move away from the dollar for political diversification, well, you ain't getting that benefit. So those are a couple of knocks on the Eurozone. The Chinese yuan, I mean, what can you say reasonably diplomatically without this going viral on the net? We know that yuan is pegged to the dollar. It cannot be easily converted into other currencies or foreign assets. At any given point of time, there can be restrictions on the outflow of both capital and currency. Not ideal. And finally, the basket of currencies will have the same issues. It will have fragmentation risk. You won't get a whole lot of political diversification. They'll be less liquid. They're more expensive to trade. So we come full circle back to the dollar. And it's remarkable how, even with the declining share of reserves, the blue line, the price action in the dollar has just remained strong and steady. And that's because we just have so much more to offer. The US has strong economic growth, has incomes, low inflation, well regulated capital markets. The dollar itself is stable, liquid. We have good governance. We have a strong military. The list goes on and on. So I do think things will be okay with the dollar coming up. And so allow me to summarize finally and then hand it back to Teague. I mentioned my belief is that inflation was meaningfully transitory. The transition got postponed because you had so much excess stimulus that it sparked off that inflation, which took a while to come down. I shared with you my kind of point estimates, one number to latch onto at the end of next year, core PCE at 2.6%. That will be the terminal rate. The Fed will soon be so restrictive they'll cause more damage. The consensus is for four rate cuts in 2024. By the end of 24, I suggest we might see a couple more. Here's your big question. This new prospect of the no landing, I think, has gained so much traction. It's probably a higher probability than your hard landing. So no landing more likely than hard landing. But of all the three, the soft landing, we may be okay right now in Goldilocks territory, but there is downward pressure. So the soft landing of close to zero growth is still my base case. I gave you levels for the 10-year interest rate, and I feel pretty comfortable that we are in a new equity bull market. Teague, I don't know how much time this leaves us, how many questions came in. I'm going to stop talking, have a sip of water, and let's see what we got.
Well, thanks, Sandeep. That was a lot to digest in a very short amount of time, actually. So we had a number of questions coming in. I think right off the top, I think one of the biggest questions on everybody's mind is the Fed done hiking this year? We've seen so many rate increases. Are we all set here? And kind of as a corollary to this, what would be a policy misstep, in your opinion?
So hark back to the early conversation on inflation, right? Today's data showed core CPI is 3.7, headline is 3.7, core is 4.3. Let's say inflation is at 4%, the Fed is sitting at 5.4%. They're 140 basis points, 1.4% above inflation. Inflation, which could yet be trending lower. I submit they're already restrictive, and they will soon become so restrictive, they're going to start breaking things. The regional banking crisis was because of rapid tightening, right? And before those accidents happen, they really need to start cutting rates. So if my view that inflation, let's say we are close to 3%, the Fed funds rate needs to be at 4% if inflation is 3% in 15 months. That's 6 rate cuts. And if they do not get going, right now it's expected that the first of these rate cuts will be in June, and they'll barely get to 4 reluctantly. If they stay with that or become even more stubborn and stay higher for even longer, that'll be a huge policy mistake.
So let's just jump on one of the last points you made around China and yuan. Is the Chinese slowdown a big global issue? And how will this impact U.S. growth, in your opinion?
Look, the global economy is supremely interconnected. China is the world's second largest economy, and it's the largest trading partner for both Europe and the US. So You simply cannot ignore it. So here's what is indisputable. They're not growing at the 10% levels that they once were. They're in a steady decline to low growth. Unlike every other economy, what they haven't done so far is pull out the big bazooka by way of fiscal stimulus, right? So they still have that in their back pocket, which could soften the blow on the decline. And this will cut both ways. Slower growth from China admittedly will slow growth globally. So that has implications for revenues and earnings. But a slower China is experiencing disinflation at both the consumer and the producer level. If that disinflation gets exported, all the numbers I quoted will get there even sooner. And the Fed will be like cutting 50 basis points before you know it. So it goes both ways. At this point, I want everyone to recognize that they are no longer the growth engine that they once were. But I don't think they will come to a grinding halt so soon that it's going to create a big abyss or a cliff because they still have that policy weapon of fiscal stimulus. So worth keeping an eye on, but not disastrous right now.
All right, let's jump back to the U.S. real quick here. Do you have any concerns over the safety of U.S. Treasury notes given this political environment and all the threats coming out of Congress right now?
So, Teague, I'm assuming you're talking about the fiscal outlook and the reluctance of the politicians to kind of keep an eye on spending and be fiscally responsible and to stop the job owning that creates a debt ceiling crisis every now and then. So I can't control politicians. In fact, in my seat, my only job is to offer economic commentary. Our debt to GDP ratios have gone up. In a world that I just described, I don't see runaway interest rates. And if inflation comes down to 2.6% and our US economy is capable of growing at 2% real GDP growth, the sum of the two gives us about 4.5 to 5% nominal GDP growth rate. Nominal interest rates may be at 4. As long as your interest rate is below GDP growth, your debt to GDP ratio won't get worse. Debt grows at the rate of interest rate, GDP grows at the rate of GDP growth. One is higher than the other. So the ratio should remain contained unless they engage in irresponsible spending for the next 30 years, which I'm just hopeful, despite all of my skepticism. God, this is political commentary, refraining from it. I hope saner minds prevail and the spending kind of does get balanced. But right now, not concerned that the fiscal outlook is dire, fiscal policy is out of control, and through a massive crowding out effect, that alone is going to push interest rates higher by 1%.
Gotcha. So staying in the U.S., right? We have a question around the declining labor force participation, which just kind of ticked back the other direction. But if we continue to see declining labor force participation, is there an existential risk to our economic model or to the capitalistic system we're in? And kind of along those lines, where do you see labor force participation going in the next, call it 6 to 9 months?
Oh my God, why, why stop at 6 to 9 months? We're in a secular decline, right? So it's easy for me to extrapolate that it will maintain that trend. Sadly, I mean, I looked at 30-year data. It was just very morbid to kind of make comparisons of birth rates and death rates. And uh, it's a and demographics change slowly. They're highly predictable. Just right now, before you hang up this call, be conditioned in your mind, we will not have enough workers in the US. And that at the margin is going to result in slightly higher wage inflation and overall inflation. So if the Fed is fixated on 2%, they ain't getting there, right? We'll live in a world of 2.5 to 3% inflation. Having said that, I just don't think it's debilitating. We got spoiled with 2% in the period between the global financial crisis and COVID, but that was because the GFC was a severe financial crisis after which you had a lot of deleveraging, and that just crimped spending and just didn't ignite inflation. 2.5, 2.75% inflation is normal over 100 years. It won't destroy the U.S. bond market. It won't cripple the U.S. economy. It won't paralyze the U.S. stock market. So those are my quick thoughts.
So you mentioned the GFC, you mentioned 2008. I think one of the things that's happening across this economy and this go around is mortgage rates, right? Finally seen mortgage rates increasing pretty substantially. And given where we are in those increases, where do you think we are in terms of the housing market? Is there anything like potentially seeing 2008 correction, or where do you think we are with that?
So there are so many differences in the limited amount of time. I have one eye on the clock here. Uh, I don't know where to begin. The biggest driver that will provide support to the housing market is we have a hopeless imbalance between supply and demand. Mortgage rates have quickly made new homes outright unaffordable. My view on rates was a bit sanguine. I'm not a flaming bond market bear, thinking that rates go up to 5.5, and if long rates get there, it'll put upward pressure on mortgage rates. I actually see a small decline in rates, so there should be relief on mortgage rates. That if you're above 7, we could be below 7. And if you are a new home buyer and in the market and you're still spooked with that really high mortgage rate, when just a year ago you were thinking of mortgage rates of 2.5 or 3%, don't fret, right? Everything in this world comes in cycles, especially in finance and the markets and the economy, even so in life. So just kind of suck it up, and you will have a bout of weakness. The next recession will happen at some point. Rates will come down. Go ahead and refinance at that time. So it is hard. I don't mean to be flip about the plight of the new home or the first time home buyer. It is extremely painful, but those are my thoughts in terms of what lies ahead.
Excellent. I think I'll turn it back to you. We're running up on our 1 hour here. So any closing remarks or comments?
So I just want to thank all of you for making the time to join us. Teague, I don't know how many of the audience questions we were able to plow through. If I missed any, I'll be sure to get back to you by email. And if you have any other questions now or at any point, please do feel free to reach out to your portfolio manager or your client advisor. I hope my next meeting with you is in person. We do have mobility and freedom now. And until such time, I will say goodbye and so long. Thank you.